Hey everyone, welcome to this week's episode of the Squawk. I'm Pav, lead market analyst here at Swyftx, and we're here to talk all things interest rates. We've been talking about it for the last couple of weeks, that we thought there might be some mispricing in market expectations that, hey, look, there may actually be a rate cut coming, which was totally understandable. At one point, the market really did change its tone completely in terms of expectations for interest rates. The market was almost back to the idea of zero cuts for the rest of the year, but now we know that's not the case. We saw that Fed rate decision come in. It's a quarter point drop. That does move that effective interest rate zone. It's usually a buffer range. It's not an exact figure, but between 3.25 and 3.5%. So what does it mean? Is it good? Is it really good? Is it just okay? Obviously, I think for me personally, time will tell. We are just coming out of a pretty important period for the markets. We have been talking about in previous episodes that the overall economy in the US, which again, largest consumer base in the world, that is essentially where we see a lot of GDP start and also spread to the rest of the globe. They've only just wrapped up what we call quantitative tightening policy, so QT as that's effectively known as. Though since 2022, been siphoning money out of the system. And it's only recently that we saw the excess of cash being removed out of the system, even being stored away for future spending, really start to cause a bit of stress in the markets. We saw cash become a little bit scarcer. Talked about that 2 weeks ago. Go check out Swyftx Loans and go and listen and watch that particular video. But more recently, we've seen even just these reserves, like I just talked about, move from $299 billion to almost $1 trillion. There's just been this persistent drain on money in the system, and that definitely hasn't made the landscape any easier for crypto. But with this rate change, could we start to see this script flip a little bit? And that's the key thing that we're going to break down today. How is the mood shifting? What is the data changes, as well as even just the tone shift that we're seeing from the policymakers? Because that's essentially all the market has to go by. Basically, what we're going to dive in today is just that. We can see that since 2024, we are seeing a gradual dropping in interest rates. We're now sitting at about that level there, with the final meeting done for the year. It's going to be a little bit before the next time everyone gets together. But the key thing that comes out of these meetings, while there is the result that we can see, like the rates have been dropped, there's always a press release, there's always a conference, there's always a lot of questions. They get dissected to infinity to try and work out, well, what is the actual view moving forward after this meeting? Because if you don't remember, back at the end of October, we actually had the opposite message. It's almost been a 180 flip by policymakers, which again, it's going to give the market whipsaw enough just trying to get their head around this to some degree. But some of the key quotes that I've pulled out of the statement for everyone that I think kind of resembles and embodies a lot of the way that the Fed might be thinking, and I'll show you some data soon to articulate that further. There's definitely an emphasis now for the first time, in my mind, that unemployment concerns outweigh the concerns of inflation. Now, there was complete admission that they don't agree that inflation is completely under control, but now they're starting to be more concerned that the labor markets, or the job market, is potentially accelerating in its degradation, which is, again, the key mandate. The tightrope the Fed they walk as an independent body is too much growth and not enough growth, too much inflation, not enough inflation. So it's finding that happy medium between those two mandates. But here's some quotes. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. It's a challenging situation. With downside risks to employment having risen in recent months, the balance of risk has shifted. The committee judges that downside risk to employment rose in recent months. So again, if we pull this apart, the acknowledgement that the risk is almost accelerating from what they originally thought in the previous meeting, that's a nice tell for the market to understand that they'll be watching job market data a lot closer now. So that's something that we as pundits can also go away and keep an eye on. But that shift in language, it's very purposeful. Like, it's not something out of whack or just mentioned as a side note. There really is this overwhelming emphasis in this whole statement, which you can go read yourself, that, jobs are more important than inflation at the moment, right? So we just need to also keep in mind that these tones can shift as well. But then when we turn to the economic projections, which also come out in once a quarter from these meetings as well, they basically lay out the forward guidance. What can we expect from decision makers moving into the future? There's two things I want to show you on this. Here's some of the metrics that this committee look at when making a lot of these decisions. So they're looking at changes in GDP, so growth, unemployment rates, and inflation. So if we look at the September projection, which is the last time we saw this data come through, we can see that the committee believes that there is going to be an increase in gross domestic product, or GDP. They believe that the unemployment rate needs to stay steady, and they believe that inflation will drop. So it's almost like we're heading into this, you could call it like a Goldilocks zone where inflation, they expect to come down, they expect growth to accelerate, but jobs to stay flat. So if we go into the mindset of, well, this is how policymakers are thinking, now when we see the data prints come out in the new year, we want to understand how does the data match how the policymakers are thinking about the future state of the economy. And we can see here that the other important thing that comes out of these economic releases is the dot plot. We've talked about this at length in the past. It basically starts to shed light on how, again, these committee members it's basically looking to forecast what are all the committee members think is an appropriate level of monetary policy when we're talking interest rates specifically. So we can see at the end of 2025, they expect the terminal rate to be between 3.5 and 3.75. But then we head into 2026, we can see it's pretty widespread. We can see that essentially the consensus, while it is very spread, there is still a wide variety of opinions that some members believe that we could be as low as 2%, whereas others believe we could still be at 4%. So again, when we look into the data here, we can see as we move into a longer term outlook, 2027, 2028, there is some sort of consensus that we're moving closer to that 3% mark. But what we can take away from this is that if you look at the majority of committee votes right now, they do see rates reducing in the new year. But that's it from me here today at Swyftx. We'll be back next week to see what's happening, review how the markets are moving. But until then, I'll catch you next time.